Welcome back to Around the Table with Stacy Smith as we take a look at investing in the economy. We have talked a lot about the stock markets and bonds and interest rates. What we haven't discussed much is the dollar. So, Frank, why is the value of the dollar so important, or is this just a boring conversation?
Well, it's important. The value of the dollar is important. And what's happening right now is the dollar has been strengthening. And that is because of what's going on in Eastern Europe, what's going on in China, what's going on in the emerging markets, what's going on in Japan. These economies are all struggling, and our economy is not. So it's become a receptacle for other people's money. Plus, we're paying real interest nowadays. So your money's getting rewarded by being in the dollar. Whereas Japan's dropping interest rates because they're trying to get things going. China's doing the same. So right now we have a competitive advantage for what money pays to be employed. So our dollar is stronger. That is good for inflation, believe it or not. It's incredible to me that the oil price is up to 100, which trades in dollars when our dollar is this strong. If our dollar was up around 120 on the euro or 130 on the euro, where it was a few years ago, the oil price would be much higher than it is, which is kind of interesting. And I'm not enough of a mathematician to tell you what it all means, but right now, oil prices are actually being depressed by the strength of the dollar, believe it or not. So it's important, but it doesn't mean a lot to the everyday person when you go to the grocery store.
Yeah, we have clients that talk about the dollar and the demise of the dollar, and they're very worried about the valuation of the dollar. And what I tell them is when you look at the currency, you have to compare it to something else all the time, pretty much, right? So when you say the dollar is in trouble, and compared to what? Compared to the euro, compared to the yen, compared to the Chinese yuan, I still think that the dollar is the best house in a bad neighborhood, for lack of a better term. So that's the first thing I'd point out, right? I mean, again, we're not at the point where cryptocurrencies are going to be taking over standard monetary fiat currency. So the dollar, to Frank's point, is again the best house in the bad neighborhood. The US dollar is the reserve currency of the world. The second thing is, from a stock market standpoint, we typically look at relative valuations of the dollar and compare to the euro. And when we make our tactical moves to overweight or underweight US stocks versus international stocks. If you go back 40, 50 years, trends in the dollar movement, if the dollar is trending upwards, US stocks tend to outperform international stocks. If the dollar is depreciating in value versus the international currencies, generally international stocks outperform US stocks. So that's a pretty good, very, very basic way of taking a look at whether you want to be overweight or underweight international stocks versus US stocks over a 3 to 5 year period.
Do you want it to be an equilibrium between the dollar and, let's say, the euro or whatever other currency there might be, or do you really want the dollar absolutely to be stronger every time?
No, I mean, in terms of just in general.
Yeah.
I mean, the dollars generally can't continue to appreciate versus the euro, because generally those interest rate differentials, which drive a currency valuation, will tend to widen out, and then people will start investing in the euro versus the US dollar. So if interest rates in Europe get to the point where they're 15% versus 5% in the US, investors are going to want to park their cash in the euro, earn that 15%, and that ends up driving down driving up the price of the euro versus the dollar. So they usually stay within certain bands over the long haul.
A good way to think of this is, do you remember playing with a gyroscope that once it started moving, it would kind of go along a ramp and then go up and peak and then come back and come down? That's the way to think about the dollar relative to other currencies. And in my opinion, it's strongly driven by interest rates. The fact that the US increased interest rates so dramatically allowed people to go on really great European vacations in 21 and 22 because Europe was on sale. It's still kind of on sale, but it was really on sale then. I also think, as a stockholder, you have to look at your portfolio and look at who would be damaged by a strong dollar. Now, some companies like Microsoft they sell mostly their products in a dollar denominated environment. They're kind of a monopolist. Like no business is going to switch to Google whatever it is, Docs over Word if all of their corporate belongings are stored in Microsoft files. But that being said, the incremental dollar, the new customer will probably defer buying more Microsoft products. So you have to watch, especially tech stocks and companies that export a lot. So look through your portfolio to be cautious about holding those global stocks when the dollar is getting stronger.
Okay, Shayna.
Yeah, and to Kim's point, the dollar is important because about 40% of the companies within the S&P 500 generate revenue outside of the United States. So that fluctuation in currency can impact the company, impact their corporate earnings. We saw this play out a little bit last year. So it is important to just be aware.
All right, great. We have to take a break. We'll be back in just a moment.